All right, cameras on. It is the end of the week, so that means this is Junior Mining Talks, and today we're doing something different, but kind of the same. I've got a couple of DMs, Luke, and emails over the last couple of months about royalty companies, and everyone seems to agree that they offer a superior business model to people looking for a sensitive risk reward profile within the commodity space, if that even is a thing, although saying it out loud kind of makes me doubt that even is a thing. But luckily for all of us, Luke is not everyone. And to no one's surprise, he's made a list of a couple of things. And we'll look at royalty companies today. We'll see if they really are a good risk reward or whether prospect generators might be a better model than that. We might even end up talking about the valuations on royalties because they're very, very popular right now. Everyone's kind of in them. Are they becoming overvalued? If we have time, we'll touch upon that as well. But just very briefly, royalty companies focus essentially on acquiring or creating passive income streams from ideally producing or near producing assets, which the idea for those assets is to provide steady cash flow with as low of an operational risk as possible. Prospect generators, then, on the other hand, they focus on the early stage in the Lassonde curve and the exploration process. So they focus on early stage exploration, and they spread the risk by partnering oftentimes with bigger companies who would then fund the expensive part of the work. And then they're going to keep a smaller, or well, essentially really a small stake most of the times in the potential rewards that could occur from there on, but also a smaller part of the risk, right? Because they don't have to finance the risky part, which is the early stage exploration stuff. And Luke, I actually want to do the other way around, where we start with the prospect generators first, because I often wonder why. I look at these things and I wonder, why should I not just go for straight exploration plays if I'm already doing the work on the share structure, the team, the financials, the geology, and all that? Why? I mean, yeah, if I like an asset, why not go for it, just straight exploration? So talk to me. What's the risk reward here? Why do you like it?
Yeah, we had a bit of a pre-talk. We talked about a different topic, and we talked about story and business. And I think actually you came with it. I don't want to claim it directly, but I think most companies. You were asking me like, why do people call it stories? I don't like stories. I want to invest in real things. I don't want to invest my money into a story or into a play. And I think actually most of these companies are actually a story. You stake some claims. It doesn't have to be expensive. You put a team into it with cheap equity, and you make a nice PowerPoint, and there you have your junior mining company. And then you promote really hard to get some money, and you drill a couple of holes, to really put it simple and very skeptical. And but that's a little bit what it is. And there's only a few companies in the junior mining business, I think, that can be considered businesses if you look at the sub $100 million companies. And to become a business, you need to do something that is, smart and not just taking bets. And prospect generators, they really think about the business model. They try not to spend too much, and they try to do a deal where they get income, management fees or option fees or shares or royalties. And they don't have to take too much risk, because this is a very risky business, and they de-risk themselves by not spending 10, 20 or $30 million, but let others spend it and do the cheaper work, the knowledge work themselves. And it's really a knowledge business, as we often hear. So I think it's a very smart business model, but a bit of a boring business model in a way, because you don't get that, one amazing project type slide, and people get excited about, one project with a big anomaly on the PowerPoint slide, but rather they get 20 or 30 projects, and their interest is divided over those 30, and it becomes a bit boring in a way. So that's how I look at it. I think it's a better business, but it's probably not as ideal for promotional purposes, and that's why these companies could be perceived as boring and therefore not interesting for the high risk speculators in this business.
Well, and I understand the risk portion of it, where you are obviously lowering the risk, but I still trying to think about it in terms of risk reward, because what is really the reward that you would get here? And I'm kind of trying to be devil's advocate here to understand what happens, and this goes back to conversations that I've had with Rick Rule, for example, about the uranium space, where producers will forward sell a big part of their production. Investors get disappointed. Those stocks then oftentimes underperform, even though it is a more sensible business move to forward sell your production, because they're like, oh, but the uranium price is going to go up 1,700 times, and you can make a whole lot more money at that point. And so, yeah, I mean, I understand your argument on the risk, but talk to me about the reward as well. Like, how much does your reward or your potential reward drop with prospect generators?
Well, if you assume that very early in a program of a project that you own completely, you make a discovery, of course, you give away a lot. Um, it's less likely to get a great bear type outcome if you are a prospect generator. But on the other hand, you can also control your share structure more. A company like Reservoir Minerals had to drill really deep holes to test their targets in 2012, and therefore they optioned it. And the option partner made a discovery at a depth of 1,000 meters, I think. And they only owned 25 or 30% of the project, free carried. And that company was taken over for about $400 million. And it's not just the sum of $400 million. It's also the fact that they didn't have to dilute their share structure, and they were taken over for $8 or $9. So they went from probably 30 or 40 cents to $9. That's just out of my head. I have to check that again, but it was a really big return in terms of share price. Would they have made this discovery themselves? Of course, without an option deal. But then you have to drill these extremely expensive holes. And what if the first one is not, doesn't hit, and you have to raise money again to drill another 5 1,000-meter holes? So Reservoir Minerals is one. Mag Silver only owns 40%. It is a company that with a market cap of $1 billion or $1.5 billion, $1.5 billion. Cornerstone is one with Sol Gold, and also the Hemlo discovery, I think, was initially made by a joint venture. You have Sirius Resources with the nickel discovery in 2012, which was 70% owned. Entree Resources. I mean, there's many examples of companies owning something between a royalty and 50-60%, and still providing good outcomes. So I think it's indeed you will not likely get the 50 or 100 bagger, but the likelihood of that getting it is very slim in the first place. So I think if you want to invest responsibly, with less risk of the complete company going broke, it's probably a better business model.
If you keep sliding down, you're going to disappear off screen, by the way. But what I want to, and you're the perfect person to ask this, because I know you like quantifying things, but how much of the risk are you giving away, and how much of the reward you're giving away? Because let's say you start at the beginning as a junior explorer, you start with 100 units of risk and 100 units of reward. Someone says, hey, I'll drill your project if you give me 80% of it. Clearly, you're giving away part of the upside. Now, are you giving away 80 units of the upside? Or, I mean, let's say they find $1 billion deposit. Is your 20% is then technically worth 200 million, but is that the valuation that the market is going to give you? Because the market might only give you half of that. And then essentially you gave away 90% of the upside. But how much of the risk did you really give away? Did you also give away 90 or more than 90 units of risk away? So that's kind of, I don't know if I'm making any sense. I'm just kind of thinking out loud at this point, but how much of the risk are you giving away, and how much of the reward are you giving away?
I think you give most of the risk away. And I think it's mostly a reward thing, because people probably would consider not buying such a stock because of the reward side of the equation. And that's why it becomes maybe more difficult to raise money when you need to. So I think there's a lot of different factors that play a role. These companies do not have to raise money a whole lot, but they do have to raise money every now and then. And sometimes it's easier to raise money when you have the project completely, and it could even bring down your cost of capital in a way. But in my opinion, most companies ultimately fail because they have to issue too many shares every time again to finance and to finance and to finance, and will not never find something. So I think the risk mitigation part is most important. But I do see the concern about how much value will you get, and that of course depends on the deal as well. If you are free carried to production, for example, you have 30% of the project. I think it's likely that you get a good part of that 30% in your valuation. If you would only get 30% equity into a company and you can be diluted down, I mean, there are companies trading, they have $16 million in investments and trading at 30 or 20 million. So you can really trade below your equity holdings. So I do think that a company needs to keep a real interest in the project, not just in the company taking the option. And it really depends on the deal. And I think we will have a look at the Kinoland deal in a moment. And I think that's a very well structured deal where they will get value if a discovery is made. So it really depends on the deal terms, and it could even go as far as small contractual differences that have a big impact, like a rover, for example, which played a big role in the reservoir minerals valuation. I think because of the rover, that became a really successful story, part of the success, I think. So it's not just the terms, the headline terms, but also well structured contracts for the juniors.
Contract type, contract details, plus counterparty. I'm writing it down because that's something I did want to talk about, and otherwise I'm going to forget. But the way I think about it here is that yes, the way I understand that, where you keep a decent part of the project, that it might work for you long term, especially on a risk reward basis. But is that if you make a mid-tier discovery, so not a tier one? I think a lot of the examples that you gave, maybe they're not perfectly classified as a tier one, but they're very significant discoveries. So let's call it tier two or even tier three. Would the prospect generator benefit from that discovery at all? As in, would its share price really move if it's not a tier one? I mean, wouldn't it really have to be a tier one discovery for a prospect generator's shareholders to see a reward that's sufficient to cover the risk? But let's say if a small cap company makes a tier two discovery on their own, that often does translate into higher evaluations, all other things equal, of course. But again, that's maybe me being too shallow or oversimplifying it. So what am I missing? What do you think?
Yeah, but I think it counts for both. If you would drill a project yourself or you would option it, I think it has the same impact. I mean, if you make a tier two discovery, I mean, Vizsla Silver has a really good discovery, but it's probably not the discovery that Rio Tinto would buy, or even Agnico Eagle. Probably, the companies with a market cap between $1 billion and 5, 6, 7, 8 billion. It's a project that is meaningful to those type of companies, but not to the super majors. So I think even if you have a sort of smaller high grade discovery like Adriatic Metals, it's again about how do you treat your business. Is it a business or is it a play? If you really protect your business, you're trying not to issue too many shares. You have, good investors. You can still have a market cap of something between 200 million and $1 billion. And if that valuation comes with only 20 million shares or 30 million shares, then you talk about a $10 million or $20 share price. So in the end, it's about a share price as an investor, I think, in these things. And if you then only own 20 or 25%, like Reservoir Minerals did, they were sold for, I think, $8 per share. So it's a real return. Mag Silver is probably something similar, high grade silver. Maybe would it be tier one, tier two? But again, a company going from a couple of cents to multi-dollar. And I think there's many examples of companies only having even a royalty. Great Bear Royalties was sold for $200 million for just one royalty. Abitibi Royalties was sold for $220 million for just a royalty. So even a royalty could give you that payday, and I think 25 or 30% of a meaningful project, even if it's tier two, like Adriatic, for example. Adriatic is not a royalty, but that is a small project, high grade, $1 billion company. If you would own 25% of that project, it's likely that you would do a deal with Adriatic at some point, and put it together. So I think for a good project that ultimately will become a mine, it will lead to a successful outcome. But of course, not the 100%, but the smaller part of the minority ownership.
I definitely agree that from a business perspective, it makes sense. Just like Ford selling your production makes sense, or at least part of it. All other things equal again. But then I wonder, is that what you want out of junior mining? Like, do you go into the junior mining space because you want to invest in decent businesses? Because I think that's kind of a lost battle to begin with. These things they're listed on a lot of them on the TSX Ventures exchange. They're ventures. They're startups, right? You don't invest in them for a sustainable business model that you can kind of get 20, 30, 50% return or CAGR of, I don't know, 10% per year. That's not why you go into junior mining in the first place, would kind of be my thinking. So is that even what you want in the first place? That's more of a philosophical question. You're going to let me go off on a rant here if you don't interrupt me. But is that what you want in junior mining? Do you want a sustainable business model, or do you want a crapshoot? It's essentially.
It depends what your investing strategy is at that time. If I buy stocks that I fully anticipate to sell within a couple of months because I think it's a play, as everybody is excited, or I think everybody will be excited about it, and I am anticipating that excitement and I'm buying the stock, but I know that the business model is not sustainable enough to be in that stock for long term. So in that case, you prefer to just, the company to make a bet on a good outcome and make a lot of money on it. But if you really plan to own a stock for 2, 3, or 4 years, a junior mining stock, I think you have to think about it as a business and not as a play. I think we discussed Lara exploration 2 weeks ago a little bit. And I think if you take Lara, which is a prospect generator, you take all the results of the last 10 years, but all those results were created themselves by drilling themselves, exploring themselves, paying for it themselves. Lara would not have been a $1.30 stock, I think. I think it would have been a 10-cent stock right now. So I think with the same results, but not optioned off to all kind of partners, but all doing it themselves and raising money for it. I think instead of looking at a $1.30 share price right now, you would be looking at a 10-cent or 5-cent share price right now, unless they rolled it back. But and I think for a number of companies, every company in junior mining is very risky, but these companies allow you to buy it at a point you think it's worth a buy and own it for a number of years. And I cannot think of many companies I am comfortable owning it for a number of years because they're taking so much risk by drilling holes everywhere. Even if it's an amazing target, in most cases it doesn't lead to anything except for share issuances a couple of months later again to finance the next round. And that's why almost all companies in the end go down, go broke, or not broke, they just roll it back and put a new story into it. But as an investor, planning to own it for a long term, I cannot do that with any company rather than a responsible company. And a prospect generator could be a model that is responsible, and there may be a couple of other models too. But it is always, I think, prospect generator / royalty is the only way probably to take risks and do bets on drilling without risking the complete company.
I think, and I've started asking this in my CEO interviews as well, but I think everyone, irrespective of the business model you're going for, whether it's an exploration developer, a royalty, or a prospect generator, whatever, you should ask for the business case. You should not ask like, hey, tell me the very exciting story that's really going to get my blood flowing and have me FOMO into this thing, but explain to me what is the business strategy? What are kind of the milestones? What happens in between those milestones? How much is each one of those steps going to cost you? Let's talk about this thing as if it were a real business, not as if it were a story or a play or something like that. So I think irrespective of the business model, that's how you should approach it and think about it. Does this make business sense? This is also where geology comes in, by the way, I suppose. And then something I just recently wrote on Twitter. It all comes from you well, the majority comes from you. I suppose another part comes from other people I've spoken to as well. But essentially, I wrote something along the lines of geology is the foundation, equity dynamics, and so the business model and everything else are kind of the building. So if the foundation is very bad, so if you have a sub-economic deposit or something like that, the building quality is not going to matter. And over a long enough period, you're going to get diluted out of your ownership, vice versa too. Like if you have a very good foundation, so a good project, but you have a bad vehicle essentially and bad management, then you're building a cardboard building or something like that. It's essentially also going to not work out well for you in the long run. Now, what I wonder though is within the prospect generator model is that it depends on the strategy, as you mentioned, but also maybe depends on the investor himself. So it almost sounds to me, correct me if I'm wrong, like the prospect generator model is a little bit of an insurance against mediocre geology. Does that kind of make sense?
I always struggle with calling something good geology or bad geology. When you invest in a team that you trust, I mean, if you invest in Azimuth, we talked to them recently, you assume that they look for the right geology in Quebec because they are focused on Quebec, to look for all kinds of minerals. If I invest in Sunpeak, which we talked about a couple of times, I assume because I know them that they will, look in the right geology in Ethiopia for VMS or perhaps even orogenic gold. No company would tell you like, hey, we are going to look in this bad geology to look for an amazing project. So I everyone will tell you that they are looking in an amazing place to find an amazing project. And of course, if you're looking for a nickel massive sulfide, it's more likely to find a company is more likely to find something from me as an investor point of view in belts that have generated other big massive sulfide type nickel discoveries. So if you then start looking in a place like even Voisey's Bay, for example, was a bit of an anomaly. There's no other discovery of that type in that area. So you could argue that's bad geology. And why are you looking there? Why are you taking that risk? But I think that's where the team comes in by investing in good teams, because it's a knowledge business. And that's why I think looking at it as a business, most things are a play. You have nothing, and suddenly you have a very nice PowerPoint presentation, and you have all kinds of nice red blobs, and especially in a hot market, you see all these companies pop up. Suddenly, look back in history, like how did they find the project? Was it drilled before? Could it be used as a promo vehicle? Is it a story or is it a business? I think most companies are stories, plays, and only a few are businesses. So I may be moving away from your question right now, but every company that I review, my complete assumption is that it will fail, and all of them have a very high likelihood of failing. And you try to find reasons. Are there reasons to take the high risk to buy this stock? And if it's a play, in most cases, I don't want to be involved in such a thing for a long period of time, because it may spike for a while. But if they don't find this amazing discovery, it will fail again. And these business type things like Cunardland as well, you can take the risk. You can invest in good geology, people, looking for good discoveries, with not risking your entire investment going to zero. Well, there's always a risk, but way less likely going to zero compared to 90% of the other juniors. So I'm moving a little bit away from your geology question, but I think investing in the right people that really look for discoveries will make them look in the right geology. So that's how I would look at it.
I do want to talk about the right people as well, as in what are the right people for the prospect generator model, because maybe they're different than what you would need for an Explorco. We'll talk about that. Maybe not. I think fair point. I say it in the disclaimer and the warning that I typically have on screen at the beginning. Failure is the norm in the space, and it should be the expectation. So you're right to expect it that way, in my opinion. When I ask you, is it an insurance policy against mediocre or bad geology? Essentially, this business model, I was talking about the strategy matters that you're going for, as you had said before that. But does the type of investor also matter? As in, if you're a geo, if you're an economic geo, or if you really know and understand geology, should you be going for a prospect generator, or should you bet on your own knowledge and skill where you're like, this thing is going to be a tier one? You're convinced. It doesn't mean you're always going to be right, but you're betting on your own your own skill, essentially. That's where I came with that question from.
But even being an amazing geologist, screening junior mining companies, it's extremely hard to predict which company is going to make a discovery, let alone predict if it's going to be a tier one discovery. So I think until the discovery hole is there, the big hole that changes everything, no one knows. Even in the best jurisdictions, even if you have everything, every box is checked, you can still drill a couple of holes and find nothing. Origin Royalties, by the way, is also a company that right now has 1% royalty on silicon, and that's where the value comes from. But the predecessor company, I remember, found an amazing project in Mexico, I believe, did some trenching and found over 200 meters, amazing grades, and everyone was convinced, like, you cannot find these type of results even on surface and not have anything below it. And they started drilling and they didn't find anything. So the stock ran from 10 cents to $1.50. Everybody was convinced that they were on something, and then it didn't lead to a discovery. So I think there's, no matter how good the target is, there's always a very big risk of not finding it.
Not finding it quick enough and cheap enough is also a risk. Like, it could even be there, but you can blow up your share structure, looking for it as well. I think this fits very well within your overall psychology. And I've not even been able to make, I'm so focused, I've not even been able to make any bad jokes this time, but this fits very well within your overall psychology. And I'm not kidding, because you've also previously told me that you're okay with essentially never riding a great bear from the lows to the highs, but being able to sustain this thing for a long period of time, where you're just taking decent profits for 30, 40, how many ever years, hopefully your life for another couple of millennia or whatever. I don't know how we're going to figure biotech, but at that point, you have a sustainable business model for yourself, for your own portfolio, where you're consistently making profits instead of being in these big discoveries. And that's kind of the same strategy here, the same business model, but on the issuer's side. Does that kind of make sense?
Yeah, and I think if you have a very obvious discovery, so for example, you're buying Snowline because you think it's a reasonable valuation. Let's just say it trades at 10 or $20 million. There's no discovery yet, but you know that the team is good. They have pretty good investors, and you are willing to, bet on this team to explore in the Yukon, and you own it. You own a significant position, and then they drill this 200-meter hole of 2 grams that they drilled, I think, 2 years ago, and then they drill another such hole, and both of them are announced. One of them is announced in the essays, and the other one is the visuals are announced, and you feel like, oh wow, they have a real strike length already of 500 meters or something, or 400 meters with these type of holes. Then the discovery cannot really the likelihood of that discovery completely failing you and completely being nothing, a zero, is small, because you have big intercepts, consistent grade, and you have stepped out enough to know that it's gonna prove up a couple of million ounces. You just don't know yet how big it is. And in those cases, I think you should still take money off the table, but you could be comfortable and ride it for a very long time. But very often these discoveries are less. A very different one, Ramp, for example, drilled this amazing 4-meter hole of 70 grams gold. It's a small intercept, high grade. Can they find it again? I feel at this stage it's way more risky. I like it as a prospect, and I'm very curious to know what they're going to drill next. But after a 200-meter hole of 2 grams from surface, the likelihood of hitting again is way higher than drilling 4 meters of very high grade. So in that case, if the stock really goes, like 10x on a 4-meter or a 5-meter intercept, and you don't really have enough data yet to know if this is going to be repeated, then I would take more money off the table while having a couple of bigger intercepts like Snowline did, for example. This would allow me to have the confidence to stay longer and not sell early on. So I think it depends on every discovery. But of course, now we are moving away from the the prospect generator joint venture model discussion. But this is more from a valuation and how long can you ride these discoveries. I didn't play Great Bear, which was probably the best discovery story, or it was also a story, really. It was a story with an idea to test a target or a number of targets, and they succeeded. And it never really became a business, I would say, because they made an amazing discovery, and it really quickly, within 2 or 3 years, it ended with a takeover. It was not a business in a way that they had 10 different projects in a certain area, and they had option partners drilling it. And in hindsight, good for them. But most of these things are play on a area or on a project with a team on it to promote it well and raise money and try to make a discovery. So I think it's really the story versus business, which you brought up yourself, and which is probably a good way to look at these companies and see is it a bet or is it a business?
You should stop giving me credit lest someone is going to think I know what I'm doing, which I'm not. Sometimes these things come to me from somewhere outer space, but I don't really know. The point here was, I don't think we're drifting away from the conversation on prospect generators, because it is a similar approach that the company takes as to what you're taking to these things. I think same thing with founders metals, which you got a lot of internet love for last week, where you started a big conversation, is where you're saying good discovery, good geology so far, team's done everything right, financing, everything has been done very, very well. A lot of people ended up making a lot of money on, but then you said it's not for you. And you might end up missing out on a 10x here. Maybe this is the next Great Bear and it gets taken out for how many ever $1 billion or whatever. But then at the same time, you say, yes, but I'll be in something else that I could over time consistently make money in. And prospect generators kind of have the same approach, right? Maybe it is a tier 1 asset, but you don't really know until you've drilled it out. So not drilled it once where it costs you $1 million or $5 million for a drill program, but drilled it out. Maybe the drill program before you find it and define it, it's going to cost you $100 million, and you're a small cap explorer that blows up its share structure. So it's kind of the same approach. That's where it came from. But how do you measure success in that case for a prospect generator, given that they might not directly develop their projects, or even within a sale, it's not as direct of a success as if it was a big discovery? How do you measure success?
Yeah, I think you can only measure success by share price. And I want to correct, it's not like founders is not for me. I mean, founders is the type of play I also speculate in. I said no to that financing at 20 cents. In hindsight, I should have done it, but it's a type of thing that I would buy. I'm just saying, at this valuation right now, I'm not buying it. Did I own it? I would probably have taken some profit, probably already earlier. But so I'm not suggesting that founders is not going to work. It's just that it's from a risk reward point of view at this point, I wouldn't buy it, and if I owned it, I would probably sell it. But there's nothing against the company; they did a lot right. And I think success can only be measured by share price, and the founder's share price is very obviously doing well. So that's the only measure of success in my mind. These companies do not give dividends really, so the share price is the only thing to measure it. And you just test targets. And some companies are in business for 20 years and they've tested hundreds of targets and they didn't make the discovery, but they're still around, like Azimut, for example. They have made some discoveries, but not the big one yet that led them to this $10 rise, and eventually somebody takes over the company or the project. That didn't succeed yet. But would they have done the same thing without option partner? That company would have been a 1 cent or 2 cent stock after 20 years. I'm sure it would have been rolled back if they paid for everything themselves. So it's really, how do you want to bet on discoveries? Because in the end, no matter how good the target is, it's a bet. In most cases, it will be a no. And if you want to bet on these type of things, do you want to go in with an investment, sizable investment, waiting for those drill holes to come out, especially if it's a small company, and get hit in the share price, fall back to 5 cents, and have to raise money for the next round? And the dream, in the beginning, the dream is always amazing. I mean, you have a nice PowerPoint, nice images, what they will drill, and then in the first program, they're not, showing up. The results are not showing up as expected or as hoped for, and then the complete thing. Look at Sendero, which was a 40 cent stock, very exciting, close to Philo, a couple of drill holes, and the company is now a 1 cent company, and they rolled it back 1.5 cents. They rolled it back, and now it's a 15-cent company, but it really is a 1.5 cent stock. So from 40 cents to 1.5 cents, and a year ago it was exciting. Everybody liked it, and now nobody's buying it at 1.5 cents. So I think these things are bets, and you have to really understand that these things are so risky, and you're risking to lose 99%, and in businesses, prospect generators, that is less likely. But yes, you cap the upside a little bit. So I think if we look at the Canoreland deal, the one that was announced this week, I think that deal really allows for them to participate in the upside, not the complete upside, of course, but they structured the deal in a way where if a big discovery is made, they still get a lot of juice, but not as much as if they made the discovery themselves.
What is the and again we'll go back to some of these topics, talk about what makes a good deal, because I think you like this deal with Canoreland, so we'll talk about what are the bones of a good deal. But with Canoreland specifically, going back to risk reward at the beginning, what's their risk reward? Because they have a lot of cash right now. They have $30 million in cash right now. So let's say they'd spend $10 million drilling this thing. How much of a risk is that? Because they still have $20 million in cash. But with 10 million, you're kind of exposing yourself to a lot of upside with the drilling. So what is really, why wouldn't they, how does it make sense from a risk reward perspective for Canoreland to not explore this discovery themselves?
Well, I think it's if you first look at what is the value in Canoreland, and the biggest project or the biggest asset that they have is the 4% royalty on Frotet. And if you think about it, Origen's valuation on the royalty is 300 million, and Great Bear's valuation on the royalty was 200 million, and Vizsla's valuation on the royalty is currently 50 million. I think if Vizsla's royalty 2% on Panuco is worth 50 million, then 4% on Frotet could be worth 100 million or 150 million. So assuming that they own something that's worth something in between 80 million and 150 million, or maybe more, that's what they already have. And you have to protect that value. Right now there are 70 million shares outstanding, more or less, and so that royalty, once they sell it or once they liquidate it to some company, that's $1.60 per share. Every share that you print, that number will go down. So you also have to protect what you already have. I think if you spend $10 million that you already have in the bank, yes, then you could say they will survive that. But they still have a burn rate. And I think if you're willing to spend $10 million, then you also have to assume that at some point you have to raise that $10 million again. If you look at their expenditure, I think they have a runway of if they continue like this, they can continue without raising money for 2.5 years. Of course, things could happen. They could make another discovery. They could sell some shares. They could have some event where they make money from all their share, the companies that they own shares in. But just looking at their burn rate, their current burn rate, I think that brings them to about end of 2027, maybe a bit earlier. And if they start spending money on South Uchi, I think within now and 1.5 years, they have to raise money again. And I think if you look at it as a business, they already have an asset in the company that's worth 100 million or more. Are you going to dilute that very valuable asset that's not getting full value in the market right now, but they will at some point realize that value, in my opinion? I think it's wise to think about, should we bet on this project and spend $10 million ourselves, or do we stick to our business? And then their business is prospect generation and royalties and generation of projects, spinning things out. So doing I think intelligent stuff. And drilling South Uchi, no matter how amazing it all looks, the likelihood of that being a zero in the end could just happen. And then you drilled $10 million of money. You spent $10 million not getting any outcome. And right now, if you look at the deal, they have structured it in a way that if a big discovery is made, they will probably still get 40% of the value of the discovery, in my opinion. So I think it's an intelligent deal. But of course, if a discovery is drilled in the first program, in the first 5,000 meters, it's very easy to say, oh, it was a bad deal, a bad decision. They shouldn't have done this way. If 90 holes are being drilled and no discovery is there, I think it was an intelligent one. And I think it's in any way an intelligent one, because in hindsight is easy. But of course, hindsight will make people say, oh, it was smart or it was a stupid decision.
This goes well in line with, and again, I've tried to kind of play the devil's advocate, if you will, here in the conversation to better understand the model, but it goes very well in line with what Lobo Tigre talks about. I think that's one of his, well, I think that is his favorite business model. I don't want to put words in his mouth, but he's got a written article on this, and I also did an interview with him on the prospect generator model himself. But he says, and there's a quote that I'm going to take out from his website here. It says, the quick answer is that the prospect generator may end up with only 30% of a mine, but none of the risk. Going from having nothing to having 30% of a world-class mine paid for with OPM, which is other people's money, is huge value added for shareholders, unquote. And so essentially that is what it comes down to. That's kind of the whole pitch of prospect generators, neatly summed up, I think.
Yeah, very well said. I think it's and right now, in the case of Canoland, this project was, Barrick walked away. And at that point, you could argue that nobody was interested. If Canoland didn't do a good job in explaining the market how valuable they think this project still is, and they did some extra work, and their storytelling combined with their extra work and the results led to this prospect being so high value that they can do a deal like this, and that everybody thinks, oh, shouldn't they drill it themselves? So they did a very good job in, when the big company walked away, within a year of that event, maybe 1.5 years, they brought it to a point where this is one of the most wanted targets that people want to drill. So that's an amazing job. And now they have to decide, are we going to drill it ourselves? And let's just say they spend $5 million and find nothing. The complete story breaks apart and people will think, this is a failure. And then raising money for it is more difficult. And then doing a deal with somebody else, continuing work will not be a good deal. So at this point, it is a very, very valuable target in a way. Everybody wants this target to be drilled, and companies are willing to, do a deal like this, and give Canoland, accept that they have a royalty, give them 20% of the equity, give them a 30% free carried interest until PEA. So if a discovery is made, they don't have to spend anything for a very long time and still get carried. So they keep 30% in the project, 20% in the equity, they have a 2% royalty, and they get 15% of the expenditures. In my mind, that's an amazing deal. And of course, if it becomes a $500 million success, as I call it, big discoveries like Snowline, and I can name a number of other ones, they go to 500 million, sometimes more. Let's just say 500 million is an amazing success. In my mind, Canoland would still get $200 to $300 million of that value, because the royalty would then be worth $50 million. Their equity may be worth $80 million. The free carried interest may be worth $150 million. Their management fees will still bring in money. I think it's an amazing deal, and they will not get, the company making the discovery will probably get the initial interest, but in the long run, if it's a real discovery, the value will be there. And that's the same for the Frotet royalty. Right now, it's not getting the full 100 or 150 million valuation it may get in the future. But in the end, if they do smart things, they will probably realize that 100 million. And I think the same here, if the discovery is made on South Uchi, they will, in my mind, realize if it's a $500 million success packaged into one company. Right now, it's packaged into two companies, the optioning company and Canoland. I think Canoland will also get a very big part of that $500 million number, if we just use 500 million as an example.
I think a big part of the argument here is also dilution, right? Because dilution is a fact of life for the juniors. That's how you finance operations. And so sometimes you can own 100% of an asset, but by the time that asset has become something of note, it might have taken you 80% dilution, and then the shareholders who bought on day one still end up owning 20%, which is not much different than already having given away the upside before that. That's also another, that's not my argument. Again, I'm going to make myself look smarter than I am. It's a Lobo Tigre argument. The question is, and he says, by the way, in that article too, he says, quote, there's no way for a $30 million company with $3 million in the bank to pay for the exploration, let alone the construction of a mine big enough to matter, unquote. And my question, though, is where does that math break? Because if you're a $30 million company, $3 million in the bank, kind of obvious. What if you're a $70 million company with $30 million in the bank? Or, I don't know, a $100 million company with $50 million in the bank? Where does that math kind of break? At what point is optioning out a project a better idea than drilling it yourself?
I think it's really a question of the business model, really. You don't get into a position that you have $30 million of cash if you didn't do something smart. In this case, in Canolan's case, they made the 30 million in their current business model. Name me a company that is drilling holes themselves, funding it themselves, and sitting on $30 million of cash. If there is no very specific odd reason for it, I cannot even think of course, if you for example have a G2 mining and you spin out and you create a G3 mining, or maybe Greenheart is a good example right now. They have $30 or $40 million in cash after they sold G mining. Those are very specific examples. They are drilling with their own money. They have a lot of money in the bank, and they will burn down that money quite fast, I guess. But they will have a runway for a number of years, and that team is really respected. And it's a specific case. So Greenheart, that new company, is one of the few, I think, that has a really big cash position and is drilling themselves projects in South America. But almost never do you see a company that's not a business, a junior mining company, with $30 million in the bank while drilling projects themselves one after the other. That's just not a circumstance that happens a lot. So I think the only reason that Canoland is in such a good position is because of the business model. And of course, in hindsight, it would have been better if they drilled Frotet themselves, because they would have made the discovery themselves, and maybe they would be trading at 200 or 300 million right now, but with more dilution as well. So I think it's really well done, and there's only a few companies in that situation that you just described, and those companies are not often companies that are drilling projects themselves, or they have maybe a Lundin backer type thing. So only very special situations you see that companies are really cashed up for a very long time. 70 million market cap, 30 million in the bank is not really a combination that you see very often.
Yeah. I also think that this might be a little wishy-washy in my end, but I think there's a value in keeping up the business model over a long enough time period. As in, if you're going to be a prospect generator, be a prospect generator. Don't get tempted by, maybe just this one little target we're going to drill ourselves. I mean, it kind of don't go off brand, if you will. If you're going to be a prospect generator, find good partners, structure good deals, have them drill it, and just be that business. Don't be all things to all people type of thing is what I think. I think there's value in having that brand, if you will. I don't know if that makes sense.
Sorry, I was not paying attention because I was just.
It was not important, anyways.
I had to check the number of companies that really are in that situation that we just discussed. I wanted to know how many, and it's just less than 10 companies that are in that situation that we just discussed, with a market cap of something between 50 and 100 million, and with 10 to $30 million of cash. There's almost no one, and all of these companies are businesses like Globex Mining, for example. I'm sorry for not paying attention, but I had to. It was in my mind. I had to check it.
It was not as important. It was kind of a running thought that I was thinking whether whether remaining a prospect generator over a long enough time period as kind of a promise to your investors, if you will, makes sense. As in, if you do something that's off brand and you think, let's just drill this one target this one time, instead of remaining the prospect generator and focusing on doing what you do well, which is find early stage stuff, structure good deals, and retain a decent part of the upside. I think there's value in staying on brand, if that makes sense.
Yeah, and I think the last couple of years, not many prospect generators have done well. So I think the model is not looking so well right now. in a way because Midland has been around for a long time and has not really, been a success. Azimuth has done well with times, but also has a tough time right now. They were trading at $3, now it's 70 cents. In the late 2000s, 2007, 2008, 2009, there were a number of prospect generators that did really well. And I know some people that did so well in the stock market owning these things that they could just retire off, the returns they made in prospect generators. Recently, most discoveries happened in these 100% funded companies. So you could argue, they have focus. They focus on one thing, and for some reason that works. So recent, I cannot really think of recent examples where a prospect generator became really exciting. So that could be a counter argument for people to say like, yeah, give me one or two names that did really well recently, and I cannot really name them other than maybe Origin Royalties. They are probably one prospect generator that really did well recently.
And there's still risks with these things. I mean, dilution is still very much a thing. They have running costs, oftentimes, not always, but oftentimes no revenue. They cannot cover G&A. Dilution is still a thing. You depend on the partner, which is again something we are going to talk about. You depend on the contract that you closed. Management is still very much important. So there is an operational risk there. The project can stagnate and stuff like that. And a lot depends on the partnerships they go for, as in both the counterparty that they decide to work with and the type of deal they go for, as far as I understand. And so one other potential challenge I see here is that your timeline and your partner's timeline don't match, or that your shareholders and your partner aren't necessarily aligned, as in they don't have the same goal in mind, where your shareholders' goal might be to make as much of a return on their stock as possible, but your partner might not care about your stock price at all because they just need more feed for their mill, or they just want another mine essentially, and therefore they are on a different timeline. So all in all, partner and deal structure matters. But is there like a rule of thumb for what's a good partner and what's a good deal structure?
Well, I think the deal structure is everything. You, as a junior, you want to be able to release news. If you don't have news, you only get it every 6 months. Of course, there's no way to promote your story or your company. So I think a well-structured deal is where you have a level of control. In Canolan's case, they will operate the project themselves, so they will at all times know what's happening. They have a board seat. So for strategic decisions, they will be part of the discussion. I think they have news flow covered. You want to have a rover in the contract. If at some point the project is too small for your partner, you have the first option to buy it back. So there's several ways to keep a level of control in your project, and yeah, I think that's most important. And I think the promotional aspect is a bit more difficult because I think a lot of people don't like the model, and that's why it's more difficult to promote it. Some companies step away from the royalty or this model, this prospect generator model, because something is looking so amazing. You could argue that South Uchi is that thing. Virginia, for example, they had an amazing target in Eleanor and decided to step away from the model and immediately made a discovery. So is he a genius? Andre Gaumont, he was doing so well. But if you listen to old conversations or old presentations that he did, he admitted that even in 2004, not very long before the discovery, he wouldn't have named Eleanor as the #1 project within the company. He said, we have so many good projects. Eleanor was not #1 necessarily. Of course, in the months after, things happened that they still decided to drill it themselves. And I think the channel results were part of it. They had 17 grams over 5 meters and 10 grams over 12 meters. And they decided to drill under it and see if it's, if it would continue to adapt. And I don't think that's what Kinoland has right now. I think if they would have had, channel samples, real rock exposed, and you can channel it and really get, good assays, probably I would say that they would have drilled themselves at that point. But right now, I don't think it is so obvious. It's a very good target, but there's no channel sample over 10 or 20 meters of high grade where you can just drill below it and see if it continues. Yeah. I think there's many aspects to this, and you cannot completely predict what happens in the meantime, because these companies have several projects ongoing. You could get a surprise from another project. From the burn rate point of view, I was trying to model the 3 scenarios or 4 scenarios in Kinolan's case with South Uchi, but when you start thinking about it, there are like 50 different scenarios between now and 3 years, for example. So it's very difficult to model, but I think stepping away from the model is risky. And in Virginia's case, it worked really well, but there are also examples of companies stepping away from the model and then completely screwing it up.
Have you made a list on this? I'm sure you will eventually, but have you made a list over a period of time where you make a basket of prospect generators versus a basket of juniors and see how they perform? Yeah, I don't know if you've made it already, but I think it could be interesting to look at that.
No, but it would be difficult to, I mean, how are you going to assemble both baskets? Because in the case of prospect generators, if you really look for the clean prospect generators that are sticking to the model, that's quite easy because you can just find them. You probably find 5 or 10 companies. But how are you going to assemble the counter basket of 10 or 15 companies? Because of those 50, if you just randomly select 15 companies, I'm pretty sure that the prospect generators come out stronger. If you start really stock picking those 15 companies, of course, if you then pick founders, for example, then very easily that one will outperform the prospect generators. So I think if you really just take random 15 prospect generators versus 15 random companies without looking, prospect generators will win. Are you going to include the recent successes like founders or Great Bear? Of course, then the basket of 15 companies will win because of the one outstanding company in that mix. I think if you look at it from a prospect point of view, if you want to test 5,000 prospects in a period of whatever year, it's easier to buy 10 or 20 prospect generators, each of them testing a whole number of targets, rather than buying, if you can buy 10 prospect generators to have exposure to many targets, or you can buy 100 or 200 companies to have access to the same number of targets. Prospect generators will probably give you the right return compared to the better return compared to the self-funding companies.
And why I brought that up is because I was looking at the share price of Knorland, which between 2021 and 2024, really, so mid 2021 and the beginning of 2024, didn't really go anywhere. And that's what, 2.5 years, almost 3 years. Since then, it's done well. It's up like, 50% or something like that this year alone. But I wonder, because you see, when you open up the long-term chart, you kind of see this plateau in the share price where it was very high in 2021 and 2020 and so forth. But then, it was not even around in 2020. But so you see it in 2021, it was very high when it listed, and then it dropped, and then had a little bit of volatility, and then went nowhere for 3 years. Is that the risk that you're referring to when you say no news risk or something? Because I'm sure work was happening in the background, but shareholders didn't really get much out of it.
Yeah, in Kinolan's case, the discovery was made before it went public, so you don't see that spike in value appreciation, even though they only own a minority interest. That's why the chart doesn't look amazing. Again, comparing it to many companies that went down, like Sendero, for example, from 40 cents to 1 cent, you can better have this type of return. If you look at Reservoir Minerals, which is a bit of a comparison because they also had a minority interest in a big discovery, that stock went from 45 cents to the initial spike was to $3.80, so almost a 10-bagger in a very short period of time after the drill hole. And then it had sort of a bit of a boring period of a number of years where it found its sort of level between $3 and $5, $6, and it just traded in that range for a very long time until the takeover came, and then it became a $9.50 stock. So once you have the discovery and it's being drilled out by the partner, of course it becomes, the discovery is made, excitement goes down. Every now and then there's some good infill holes, but market doesn't really care because it was already priced in that it was going to work. And unless something breaks, metallurgy or whatever, the thing could really be going sideways for a long time until that value realization event. And for Reservoir, that came in 2016 when they were taken over. And then in a very short period of time, it went from $3 to $10. So you make the discovery, that's the initial event where you see price appreciation. In Kinoland, you don't see it because they were not listed at that point. And then you get the realization point where somebody buys your project or your royalty or whatever you have, and then you get that final double or triple. And I think at some point, Kinoland will get to that realization point where the royalty that they own, they are going to sell it. Either they will sell the company and spin out everything except for the royalty, and they will sell the company for 100 million or 150 or 200 million. So I think that event will come. You just don't know when. And in the meantime, you have exposure to many other discoveries, not just South Uchi. And they are not, betting the farm on one target, but they have a number of new discoveries. Last year they had another one that they will drill together with a partner. So they could make another discovery or two. And then you also have that upside. So you have the upside from the royalty, the Frotet royalty, and you have the upside of 1, 2, 3, 4 discovery programs, rather than, let's take 10 or $15 million and push it all into South Uchi and risk our business in the meantime.
Do royalty, well, we'll talk about the royalty as well, but do prospect generators have a higher G&A on average?
Lower G&A. I don't have a list, but in most cases, they have a bit of revenue too, because they get management payments for running programs and options. Sometimes they get shares every year of the company, of the optioning company, and they can sell those shares. Kinoland optioned off this lithium company into Lyft, and then they got a lot of Lyft shares, and they sold those, and that's one of the reasons their cash position is so well. So these companies are creative. They generate a bit of money, and that's why ultimately they're not burning as much money than most other companies.
So what then is difference in risk reward between prospect generators and royalty companies? They're not at all the same thing, but how would you measure that?
Personally, I don't like royalty companies to invest in myself, other than if you are thinking about, I want to get exposure to the gold market, or I want to get exposure to companies drilling holes, but I don't want to have a lot of risk. Am I going to, and I don't want to have a lot of work either. Am I going to buy an ETF, the GDX or the GDXJ? Am I going to invest in a fund like Crescat, who is looking for discoveries? Or am I going to play it another way? I think a smart way could be to play it through Franco-Nevada. They have, they will not go up on the drill hole for sure, but they do have optionality in terms of many different projects being drilled, being produced. They have an amazing portfolio, and you can get exposure to this market if you want in a very good way by buying Franco-Nevada. But the royalty companies that come in between them and the very small ones, the prospect generators, I would say, are to me not of interest, because in most cases they have a pretty interesting set of assets, but they want to continue to grow, and then they are going to issue stock to buy projects, and they will never beat Franco-Nevada for the best deals, almost never. Sometimes they do creative things. They create a deal themselves, and Franco participates in it. But for example, Horizon Copper is a good royalty company. I think they have royalties on Hot Maden and Oyu Tolgoi and Antamina. I like those projects. You have to look at the structure behind those royalty interests. But I think the risk here is that the company wants to grow and continues to issue stock or takes debt to buy more and more royalties. And it's difficult to really see a stock price do very well if you continue to dilute your structure. So I think a royalty company like Franco, if you look at the outstanding number of shares, it's not changing much. But the value, they have such a big portfolio that over time it keeps on generating returns, and they get dividends. But I think the sort of 100 million to $2 or $3 billion royalty companies are to me not of interest, because they follow the gold price. You have the gold price risk. So when gold goes down, the stock goes down. When gold goes up, the stock doesn't necessarily go up. In a very good market like 2020, they do go up, but they do not go up as much as the other companies. So I think people would argue that royalty companies are safer, and I think that's true, compared to single single asset producing mines. But to me, as a speculator, I still see risk in dilution of these sort of mid-sized royalty companies, or the 500 million, $1 billion type companies. And they don't really provide great returns. Compare all these royalty companies to, maybe it's not fair, but to technology companies, or to, I mean, if you're going to invest in these more liquid companies, I would probably consider something else than the $500 million royalty company myself. But I'm also looking for returns, big return, alpha returns, if you would call it that. And so I personally, I think you want to have a royalty company with something special, like HEREIN. They have a royalty on one of the best discoveries in the last 20 years, silicon. And then, of course, you own something that everybody wants to own, and that drives the value, and you can see it in the share price. It's $1.30 right now, and it will probably keep on going up, in my opinion, even though the calculations, the analysts say it's fully valued or close to fully valued. If you own the best discovery out there, but the royalty on it, it will get sold. There will be interest for it. And so I think that then I would look for the more special situation like HEREIN or Kinoland, because Kinoland has a royalty, but also has the prospect generation business, where you have the upside, but not so much the downside. But just investing in a pure royalty play, 500 million-ish, they are not big enough to compete for the best royalties, and they have to dilute or take debt to buy royalties. And that's not really my game, even though some people did well with it. I think Adrian Day invests in royalties a lot, and I think he has done well with it, but it's not really my risk return that I'm looking for.
I don't think you're looking for alpha. I think you're looking for drama, because by saying these things, people are going to start reaching out to you or mentioning you online and saying, Luke says that nobody ever should own royalties, and therefore he's not a good guy. And so, no, but that to the side, why not just have a portfolio of royalty of prospect generators and the royalties that you like? Like, why? Because we mostly talk about explorers, actually, you and I. Mm. I mostly have explorers. Well, I think I only have explorers in my portfolio, which maybe is a topic for a different time where you're trying to change my mind. But why not just do a portfolio of 5 prospect generators?
Well, I think this is still a business where timing is important, where you want to buy when nobody wants to buy. And I think Kinoland was a really screaming buy at 50, 60 cents. And if you then take position, then you can wait it out and have it as one of your key positions. To just come back to the royalty comments, I would like to own a royalty company, like, for example, Horizon Copper. But if the story would be, we have 3 amazing royalties, and we just want to protect the value of those, so we are not going to issue any stock. We're not going to look for new royalties unless there's an amazing opportunity that we cannot pass on. We will have low salaries, low burn rate, and we will just protect it, almost as a private company, protect the value of the royalty, because it will cash flow to us. You need to give it time. In those scenarios, it's also a boring company, but at least you don't have the risk of them, doubling or quadrupling the share structure and not really growing the share price much, only the market cap. And by growing the market cap, they have access to bigger deals. That's not really the thing I like to invest in. In terms of portfolio allocation, for the longer term part, if you really want to play discovery, I own Kinoland, I own Azimuth. Sunpeak is not really a prospect generator, but I own Sunpeak. Those are companies with many different targets that can deliver a discovery, but not with the... Sunpeak is not really a prospect generator, but they do have a lot of projects which they fund themselves, so maybe it's not right in naming them in this list. But I do participate in discovery risk and indeed prospect generators. But Azimuth was not a good, buying it at $3 would not have done well for me. So I have owned Azimuth a lot over the last 5-6 years, but I also realized at $3 when the Elmo discovery was made that at that point the risk reward to me was, like with founders, not right. So I sold it at the time, and in hindsight it was a good decision. If Elmer at that point would have continued in a way Great Bear continued, I would have likely missed out on another 3 or 4 or 5x from the $3 mark. But at that point, I wasn't certain enough that Elma would become that Great Bear type project, and that's why I sold at $3. Even though I still like the management team, I still like them. portfolio, but at the valuation of $3 per share, and that was probably $280 million or something, I felt that taking all the money off the table at the time was right, and that worked well for me because the discovery, so far at least, didn't become that next big thing. To come back to your question, yes, I do invest in these type of things, but I also invest or speculate in the smaller stuff. And what I often do there, as we discuss very often, is I also anticipate, are people going to like this thing? And when companies don't have a presentation yet, but they do have the project, and you read the documents, the filings, and you find out, oh, these people are getting involved in the company and they are buying more land, and you see the signs that they're building a new story, which is not a business necessarily, but a future story. I'm buying it before the PowerPoint comes out. It's like the PowerPoint premium will come in when they start, sending these PowerPoints to people and say, hey, we are raising money at 25 cents. Here's our amazing PowerPoint. And then you look at these very well-designed things, and then they suddenly show up at a conference. People understand, hey, there's a new company. And people start communicating on social media. That's the time when I'm taking some money off the table, because I realize it's a story. They have a project. They have made some nice images. They have shown the holes, the previous holes, and they're making people excited to participate in that bet of drilling that target. And I play those things by buying them earlier than most people. That's what I try to do. So the pre-PowerPoint period, and then I'm selling it in the PowerPoint period, when everybody starts looking at the slide deck and thinks, "Wow, this is an amazing target. Look at this red blob." And I realize they're just drilling, a target, and they will likely fail. I'm taking a lot of money off the table in these type of bets because I know it's a play. And Great Bear was a play too, and that worked out really well. So I'm not saying that every play is a bad thing. It's just a bet on a certain target.
You're bringing a whole nother meeting to Lobo Tigre's PPSS, where for him it's the pre-production sweet spot. For you, it's the pre-PowerPoint sweet spot. It checks out. Maybe you should make a list and charge for it. The pre-PowerPoint companies each month. These are the 10, 20, and then you just send it out to people. Maybe
one day I will have. I mean, Lassonde has its own Lassonde curve. Maybe one day I have the PowerPoint curve that I will be coining, and that people will, when I'm dead, refer to the guy who brought in the pre-PowerPoint period and the post-PowerPoint period, which would be nice.
Noted. People should note this. I mean, you've said it now publicly, so they cannot steal it. And if something happens, then you have it on the record. Good for you. Why are these companies public to begin with, though? I wonder, because if their G&A is lower than average, if they generate some revenue, if they're not going to finance tens of millions of dollars to drill their own targets, what's the point of being public? Why not go private, kind of Silicon Valley style?
Since most companies are plays and not businesses, you cannot take them private because they need to excite the market. They need 80 people, 100 people to finance them, and these people want to go in and out of the market when they like. And in a private company, you need people with a long-term vision. You need a strategy. You need probably to do option deals, unless you really have good backers who are willing to finance you for a longer period of time. I think it's just easier to run a play or a promotional type business when you are listed, because people can look at the share price, people can talk about it, a bit of excitement, and the retail will follow you. And if you are private, then you have to raise money with a smaller group of people. People prefer to have the option to sell stock. So I think just because most companies are not businesses, but they are stories and plays, they work well on the stock exchange. And a prospect generator could probably be private and do the same thing. So I think that the more you look at a business, the more the likelihood is that it would work as a private company. And the more it relies on promotion, the more you need the stock market.
And I have one last point, actually, that I want to get to. And that is a good answer that you're giving me here. I've asked that question to CEOs as well, where I think like you're explaining to me, your business strategy and how you're going to make money in it, and you're kind of making it almost seem easy. Why not just take it private in that case? I oftentimes get a non-answer to that question, but I think it's hard also for a CEO to say, oh, well, because we're a story and we need to excite the market. That's not something I suppose they can say, but indirectly, oftentimes they are saying it. But management, and then that ties nicely into it as well. That's kind of the last point that I have on here. But management seems to matter more with prospect generators than it might with exploricos. Not that it doesn't matter with exploricos, but it almost seems like it matters more with prospect generators. What makes a good prospect generator manager? Like, do you want geologists? Do you want MBAs, deal makers, politicians? What kind of managements do you want to see in these?
Yeah, what you often see is, and that's maybe the downside of the prospect generator in a way, if you really bet on people, especially in these promotional businesses, it's very helpful to have a big name. Like Chris Taylor right now is a big name because he was behind the Great Bear discovery, and any company he would touch, especially if he gets really involved himself, will get a bit of a premium compared to other promotional companies. And I'm not trying to say bad things about promotional, but in a way, every junior mining company is a promotional business. And when you have like the average person, or like the less, no, not Robert Friedland, not the Chris Taylors, not the big names, but just the geologists, not having access to the best money or the easiest money, but really struggling to raise money every time, but they get it done. Prospect generators in most cases do not have these figures, the typical promoters everybody knows. I think they are businesses, and they rely more on good geology, good work, and then they find good shareholders, but it's less promotional. So I think the team in most cases will have more geologists indeed, and will have fewer promotional types. It's not often that you see a Robert Friedland type promoting a prospect generator. So you rely on real work. You don't really rely on promotion, and that's why they're also maybe more boring to most people, because you don't get those exciting presentations often. You don't get the very good promoters, to promote these things. It's more a business where people feel comfortable with a trustable team. I mean, if you talk about Kenoland, if you talk about Azimuth, if you talk about Midland, and probably 10 other prospect generators, all of them have very reliable managers who have been around for a long time, who do real work, who are scientists, but are not the biggest promoters, I would say. They are just doing solid work, and that's probably not the team. It's a similar way of looking at the team than when you have something to promote, and you have the big name involved. I mean, Brian Pace Braga turned around Gold Shore recently. Chris Taylor of Great Bear could turn around a company that is in problems, has a good project, but there's not really a lot of love from the market. When he joins a company like that, suddenly, that company will get a premium. They get a premium because of the name. It's also a promotional part, basically, because you get the big name. It's a form of promotion. Insider buying is a form of promotion. These prospect generators are not really these promotional vehicles, but are more the businesses. But they are a bit more boring from that point of view. So I think that probably answers most of your question.
Yeah, it does. And you've answered quite a lot of these questions today. What am I forgetting to ask you, though? What else should we be talking about?
Well, you could ask me which prospect generator to buy right now, and I'm not gonna say it.
I should ask you which prospect generator to short, because then you get a whole lot of internet love and the video gets more views. So that's kind of
No, I think we made the point. I made my point, at least. I'm not saying it's just my philosophy. Everybody has his own philosophy, and it's not right or wrong necessarily. You need to find a way to invest in this business that works for you. And last week, some people said that we criticized founders. I don't think we did. I just think we looked at the valuation, and we talked about, is this a buy right now? And for some people's philosophy of trading these things and buying these things, it could still very well be a buy or a hold. In my philosophy, the way I play these markets, for me, it would be a sell. And in the prospect generators, it's just part of my strategy, I think, to invest in these things when I think they are cheap. Like Azimuth is a good example. I bought it recently at 51 cents on average, because I think, wow, they have the extension of lithium discovery. They have Elmo, which I think still has a lot of value. They have made 2 discoveries on surface that they're going to drill. They still have 10 million in the bank. So if I add it all up, it's not just because I think they are worth more than the current share price. I also think there are catalysts coming. There's not one drill program. There's 3 or 4 drill programs within now and a year that really can transform the company. But while taking that risk, they are backed by a bit of cash, a couple of projects that in my mind are worth more than the complete market cap. And in this situation, I don't mind taking a very big position, hoping for them to make a new discovery. But if it doesn't happen, I'm sort of protected by the asset value, which I think they will realize. For example, the lithium. I think they will sell the lithium project at some point for $20 or $30 million or whatever price it will be. And I'm speculating on a big discovery without, taking the risk of going back to 5 cents if it fails. And that's what I like about these prospect generators. I do not always, frankly, own these things for 5, 6, 7, 8 years. I also time these things a little bit. I sold Azimut at $2.50 or $3, and if Azimut would go up to $3 again because of a discovery, and I feel like I'm not certain enough that this is the big thing, I could sell it again. If I think it is a snowline discovery, maybe I hold on. So I think timing, it's not just only buy and hold all the time. Also in these companies, I try to time my way in. And in Azimut's case, that was in September when I saw this discovery happen. And I think it was cheap, Canoland, 50, 60 cents. I even bought stock for my family, because I felt like it's a fairly low risk venture that's doing smart things, and the royalties worth more than what they are worth. And in the meantime, you have discovery upside. So I really like the combination of having that sort of blue sky potential combined with a bit of protection in the value that they already created.
What has your family ever done wrong to you? Like, what do you have to put junior mining stocks in their portfolios?
Yeah.
You don't like them?
No, exactly. No, I think it has done well to them as well. I'm not taking the biggest risks with their money, but every now and then when I see some opportunity at a good price, recently there were a couple of good opportunities like Canoland at 60, 70 cents. I feel like it's something, you shouldn't do it with too much money, but with the amount that they can lose, that would be still a nice way to let even the family participate a little bit in these risky juniors.
Well, luckily, too much money is not an issue for me, so I guess I'm safe from that angle. But yeah, that's it. That's the pot. What else?
No, I think this is it. I think we covered it all. And if people are not agreeing with us, then maybe join us in a conversation. I mean, even the founders people last week, happy to, if it's interesting, happy to debate this a little bit, because there's not just one strategy. I want to emphasize that it's not, I don't think that my strategy is the only strategy. There's other ways to make money. So I don't want to just make it look like I know everything or I think I know everything. There's people doing very different strategies and have done way better than I did. But it's just a way to look at it.
Yeah, I absolutely doable. Happy to do it. Happy to have whoever on just have a good conversation, open conversation, kind of unscripted, unscheduled, if you will. And I think you got a lot of good feedback. You and Tom got a lot of good feedback for the founder story. There's a couple of people who kind of maybe took some things out of context a little bit or took a little bit too emotionally, but still, whoever thinks that Tom's geology thing or whatever that he presented is wrong, come on, let's talk about it. And yeah, my email is antonio@resourcetalks.com. Anyone who wants to reach out, Twitter, whatever, the comments here on YouTube, you can reach out. Different topics. If there's something else that we've said that's wrong, the whole idea of this thing is to, or at least for me, is to have an open conversation and have a back and forth, and no one's right 100% of the time. So yeah, let's have a conversation.
Yeah, and one more thing. What I'm also trying to do, because I think about our conversations here in public, and I have watched a lot of Rick Rule interviews and other interviews when I started in the business. There's also people reaching out to me asking like, hey, should I buy this? Should I buy that? And I try to, I'm not going to say yes, I would buy it. I'm just trying to help them in their thinking process. Like, hey, what's the risk here? What are the scenarios you have in mind? And so I just wanted, what I'm trying to do, or my purpose with this is, I think you can really make a lot of money in this business if you do smart things. And by explaining my methodology that worked so far for me, I try to be quite open about how it's possible, how I think it is possible to really make a return in this business. Because how many people really rely on junior mining to make an income? Is it possible to really make a big return here? And in a lot of interviews, I feel like you get a lot of wisdom, but you don't really get to see how people became, how they retired from trading junior mining stocks. And I'm not retired yet. I cannot really retire yet, but I've done fairly well. And I try to, give a bit of an insight how I do it. And just, I think it's good to think a lot about strategy. What are you doing? Why are you doing it? Is this the right way? Concentration, 10 positions, 20 positions. And by all these conversations, I hope that it helps a little bit, at least in the thinking process of people who listen to these things for 45 minutes, how to structure their portfolio. And I'm not just trying to, push my vision on everyone. It's just a way to do it. And I think the way I do it is working for me, but maybe other people have other methodologies to play the stock markets here.
That's a wonderful way to end it. And yep, open conversation it is, I think, always positive, and we can keep doing it. But thank you so much for doing this.
See you next week.